Good morning, everybody. For those of you that are in New Zealand, good afternoon. Welcome to our first set of our webinars starting this year. So as promised in our final webinar in December last year, we will give you these quick, short and sharp updates over the course of 2021 every month around this time. So the 20-something of each month, we will give you an update, one for Asian equities and one for emerging market fixed income. So for those of you that are on this call today, later on this afternoon, 2:30 from memory is Sydney Australian Eastern daylight saving time. We will be running the emerging market fixed income update. Okay. So I do have my webcam up, and I will jump back and forth from that. So give me a sec. We'll jump straight into the deck. Okay. So this is what we feel the world looks like to us at the moment. So for those of you that are regular attendees of our webinars, you'll see that we keep this updated every month, depending on our views. So with Biden now firmly in power, we don't believe that there's going to be too much of a difference in the rhetoric between US and Sino trade relations, solely because the US, in its entirety, has slowly realized that they can't stop the rise of China, I guess, and so they have to keep the pressure on, because ultimately China is a threat to their global superiority, which has been the case for over sort of 60 years or thereabouts. And so therefore, while the rhetoric from Biden will be calmer and he will find more traditional routes to engage with regards to communication lines and things like that, it's not going to necessarily mean that it's going to be any less of a weaker stance as taken by the US side. Obviously, there's developed market equity valuations, which are concerning to everyone. Developed market bond valuations, obviously, we have seen in the last week or so slight upward tick in the 10-year US government bond yield. So the yield curve is slightly steepening upwards. Not overly material yet. I mean, that is effectively the reflation trade that's coming through. Most people are factoring in things like the latest US manufacturing numbers showing that input costs and whatnot have shot through the roof, therefore feeding into inflation and therefore feeding into retail prices. In saying that, we're still far way off, I think, from reserve banks raising rates in any material form. And ultimately, as compared to a GFC type scenario where the recovery was more simultaneous across nations, this one was more of a K-shaped recovery, and we're still seeing that. Obviously, even if you consider locally in Australia or in New Zealand, you've got goods companies, manufacturing, selling, retail is pretty good, but then you've got things like tourism, airlines, things like that are still decimated, hence the K-shaped recovery. On the right-hand side, we've got opportunities. So we're still, the current market conditions still means it's quite conducive to equities, because easy monetary conditions are really here to stay. Greater China market bond valuations, Chinese 10-year debt, local currencies paying 300 basis points. So that's 200 basis points higher than the US. And a lot of opportunities there, which I'll more deep dive into at 2:30 this afternoon. And then the third point I want to dwell on a little bit here is investors trying to find a way to access A shares. Okay, so we've received a lot of inquiries, especially institutional lines, that people are sort of trying to work out, okay, we want to get a slice of China properly. So not proxying via US developed markets or Europe. That was a 10-year-old call. We want to get into Asia. So let's sort of talk through two main reasons. I'll just put up my webcam here. The two things that we see as the key drivers is, one is the continual development of the retail investor. So as it stands right now, there's still only about 5% of the entire market cap of Shanghai and Shenzhen put together is made up of retail investors. They're the general, casino types that are driving a lot of the volatility in the market. Then, furthermore, you've had the advent of the Shanghai Hong Kong Stock Connect, as well as the Shenzhen Hong Kong Stock Connect program, which is allowing more investors, both out of Hong Kong as well as those that are getting into Hong Kong, to actually go directly into mainland China to buy A shares. The other reason why people want A shares is they want to get themselves set in terms of buying RMB denominated assets, okay? Because of that appreciation, the long-term appreciation of the RMB. Okay, now that is very different to say that the Chinese RMB will be the next major reserve currency of the world. Well, that's not the proposition we're putting forward. But what we do see is an appreciation of the RMB over the medium term, and that's going to lead to obviously a longer term debasing of the US dollar, which is something that's quite generally expected to happen now. So hence we're seeing quite a large amount of demand and inquiry into how do we increase A shares. Our portfolios have also meaningfully tilted more to A shares, which I'll go into a bit later. And the thing is, you know, global equity funds don't do this. You can access it via some proxies in Hong Kong, but it's very different to say that I'm actually accessing direct A shares. And that's even assuming you actually have the research capability to actually build that through. And obviously the last theme there of China being the first in, first out in the economic recovery, it certainly gave us a lot of confidence into our stock picking last year. So just to recap, our investment team runs around 14 billion US dollars now. And then we're still value, okay? And this is the thing, we, excuse me, we see ourselves as quality value, okay? And that feeds through to some of our stock picks, which I'll discuss through later, because people say, if you're value, why are you not just buying banks and property and companies like that? Well, we look for structural trends, and we find those structural trends and those related companies. And with those related companies, if we believe that they're below their intrinsic value, that's what we call quality value. Traditional deep value investing is very dangerous in an environment where interest rates are zero. And that's certainly something that we don't buy into. That's how we've come across to be a quality value manager for the last 28 years. So we still have 70 men and women on the ground focusing on finding the next best opportunities. And in comparison to our competitors, one of the things that we have is we actually have our local offices in Shanghai and Shenzhen, which allows us to complete the number of company visits that we did. And every year we say we'll do 6,500 plus. Last year we broke all records and we did 8,500 visits, and I'll sort of give you an idea of how that occurred. These are not broker calls, these are not broker organized earnings announcements, these are not AGMs, these are actually meetings that we have. Obviously a lot of them were virtual last year, but for our team in Shanghai and Shenzhen, we were on the ground running by sort of May already without any issues. So we broke all records there. Just reminding everyone that we cut our fees to our Premium Asia fund, which was launched 11 years ago. Even with the performance fee still in place and a higher rate of base fee, we outperformed the incumbent, which has been Platinum Asia. And so these are the conversations that we want to have with you now, because we have a cheaper fee than Platinum. We have more men and women on the ground. You may also have seen that there has been some portfolio manager changes at Platinum. Specifically to do with the Asia fund as well as the international fund. So something to be mindful of there. Year-to-date returns have also been consistently good for us. We're sort of at benchmark really for both our strategies, both China and Asia fund, sort of getting to that about 16% total return ending last week, which is good to see. So our high conviction names are still beating above the average. All our recommendations on the research house front are just as strong, and Longsec just released their latest sector review and have maintained our ratings, so those are valid as of I think 2 days ago. So all recommended, all good there. This is a recap of 2020, and this is a recap of what we did in terms of our key stock picks and the performance of those underlying stocks. Yes, it would have been great if we put 100% all into the third largest e-commerce platform. That would have been nice, but that would defeat the purpose of building a strong, diversified portfolio for your investors. And what we did was in those sort of new investment themes, okay, in terms of internet, tech, and healthcare sectors, we have 12 full-time analysts and fund managers there, and the total number of due diligence meetings were clearly skewed to that area last year. So effectively, just under half of our due diligence meetings last year were focused on those three areas, because that's where we want to keep doing channel checks. And this is something that we continuously talk about, and I'm going to harp on about this continually, because sitting at a desk looking through numbers around a company doesn't do a great deal when you're actually trying to uncover what is the underlying channels that each of these companies are operating in. So supply chains, demand chains, because if you don't break down each of those elements, you're not really going to be able to see whether or not they've got a competitive advantage, whether or not they're sustainable, whether or not there are actual bottlenecks. These are critical factors to the way that we value our companies in our portfolios. And so that's what leads us to do 8,600 company visits last year. So one of the things that gives us confidence into just the broader market of what we're investing in is that Asian corporates have stronger free cash flow. They also have lower net gearing ratio. And this is critical to what you see here in terms of where you want to be invested. Okay, we always talk about, oh, there's a lack of transparency in Asia. There's, you know, I can't really trust them. That's why we have so many people. That's why we do 8,600 company visits last year. And that's the whole basis of our investment thesis for 27 years. Okay, so we're not fly by night. There's a lot of China funds. There's a lot of Asian funds in the region that are sort of fly by night operators. We understand that. We've built that long-term track record, and we've built that trust with our investors, which is why, you know, we have maintained for the last 16 years still being the largest and strongest China equity strategy available in Australia as well as New Zealand, and that demand is only ever increasing. So you want to find, especially in times of crisis, you want to be invested in the region that has the strongest free cash flow and the lowest amount of gearing. Okay, so even though you have very low interest rate environment as we stand here today, you still don't want to be invested in those companies with really huge levels of debt. Because as we saw even locally in Australia last year, that the banks were very, very concerned around the ability for companies that effectively had gone to zero revenue in a very quick period, try to, you know, effectively roll over their debt, and it was very, very challenging. I have a lot of mates in institutional lending at Big Four banks in Australia, and they were struggling to get credit over the line because of that level of uncertainty. So this increases your level of certainty in investing in a place like Asia. I want to talk about this current transformation of China, which is critical to sort of the next stage of investment opportunities that we see within the region. I'm currently writing a longer thought white paper piece on this because this is going to be a great tool that you can use with your clients to explain how this transition is happening within China. So China used to be the supply chain of the world, simply put, and then that is now converted to a demand chain. So the supply chain of the world is when you get pulled. Okay, so whoever wants you, whoever likes you, whoever finds your goods or services competitive, you get pulled. Okay. And that meant that you have labor-intensive manufacturing. That meant that we have this, you know, overarching theme for the last 30-something years where China exported deflation to the world. Whatever price we were given, we just have to take. Wages were below standard, still people in poverty, and there wasn't that domestic market. If we then consider what happened around in the sort of the later 80s when Japan was sort of at its peak, one of the things that was the weakest part in their entire toolkit was the lack of domestic market. Now, what I mean by that is not necessarily that their domestic market weren't consuming the sort of higher quality goods that they were manufacturing. It's they don't have the population to absorb that level if there was some other form of external shock, which we saw by the US effectively holding Japan to ransom. And so that created a sort of a really great case study for China over the last 20 years to then consider, okay, how do we turn ourselves from being the supply chain of the world to being the demand chain to the world? Okay, so instead of being pulled along, China then becomes the guy sort of pushing things along, okay, and being more internally dependent. Now, the other thing to note here is that China's internal dependence theory is very different to what was Donald Trump's internal dependence theory. US dependence theory was based on isolationism. Okay, so we don't care about the rest of the world. We just do what we do best. China is different. They want to be dependent on themselves to allow and to ensure external shocks don't impact them directly. But what they want to do is they want to ensure that they become a price maker. They want to be high-tech precision manufacturing. They are well transitioned to be an economy for a post-globalization world, because that has been something that's been on the books and threatened by Trump and his actions for the last 4 years. Create a strong domestic market, which Japan did not have, as well as internalize innovation, R&D, distribution, and brand development. Okay, and that leads into some very important themes later on. If we also then consider the recovery that we saw in China, a lot of people have seen in the past that when China faces a crisis, what do? They will go and stimulate the economy by using infrastructure. This was not the case. Okay, so infrastructure growth was at the highest point, was about sort of 3.1% for the fourth quarter of last year compared to the previous period. What boomed? Exports. Okay, so hence the stimulatory packages that went through the economy did not create the excesses had compared to what we saw in previous crises. So nowadays, Chinese consumption has converted from just, a very, very old school third world country type, small village consumer base to being a huge online shopping mall where hundreds of millions of Chinese nationals per day spend somewhere between 30 and 90 minutes socializing, entertaining, purchasing goods and services through these different channels. These are our estimates and our forecasts by 2020 of how big the gross market value will be. That is what GMV stands for, as well as the cross-pollination of these different services across the same platform. Okay. To give you an idea around how big that potential is, if we consider the percentage of consumption across Asia, across developed Western economies as well as developed Asian economies versus China, Chinese consumption via services is still very low. So the more developed nations in Asia of Hong Kong, Taiwan, and Korea are far in leaps and bounds more than where China sits in terms of the service consumption growth path, in which the US, you effectively 70% of your economy on consumption is based on services. So if China just doubled that, they still would not be at the US today. Okay, so just in the last 3 calendar years, the CAGR growth of online services has been growing at about 20% per annum, which is amazing. Then if you then split that and go deeper down and go, what is the breakdown of the underlying sectors in which people are booking services, there's still much more to go. Okay, so if you look at something like taxi hailing car rentals with the largest player in China called Didi, which they are available here in Australia, I'm not sure for the guys over the ditch in New Zealand, but only 14% of all taxi hailing and car rentals are done via online booking platforms. That's amazing if you consider the potential and how big a company like Didi already is. So if I use a case study here and consider online grocery shopping. Okay, so it's something that we know about here in Australia. I think the guys in New Zealand probably have similar services, but in China, it's been a bit more different. Okay, so this is an online platform, 300 million active daily users, As long as you confirm your order before 11 p.m. on the previous evening, then you can collect the next day before 5 p.m. Okay, so you place the order on the app. Those orders go directly via the platform to the underlying farmers. The farmers then pack, deliver, and they send it to the pickup points. These pickup points are within 300 meters of your home. Okay, so what happens is these regular mom and pop shops have effectively become distribution centers. Now, this is not amazing. The amazing part is that there's 300 million users, but that's still only, 1/4 of the population of China. What is amazing is we did a very deep dive breakdown of channel checking with regards to comparing an online versus an offline store. Okay, and we did this across all the companies that we look at, and the three biggest differences in labor, rental, and wastage is that those three factors drive offline service providers' valuations when we feed that into our earnings model. So if we consider those three main areas and another 4 other areas below where there are costs of offline, whereas online there is not, the difference is about a 16% change in the cost base. Okay, so this is our channel checking in force here. With a 16% discount in cost base, that gives us the ability to revalue the companies to higher potential PE levels. Okay, the cost savings compared to traditional supermarkets have led to a revaluation of one of the companies we're looking at increasing about $100 billion. Okay, investors right now still haven't taken that into consideration. The total addressable market in and of itself is about 10 trillion RMB per year, and our valuation marks up that company by about 30 to 50% compared to where it sits today. Okay. Then we have the situation here where the consumer base has also markedly changed. Millennials now trust domestic brands more than foreign brands because their parents were generally baby boomers who then trusted more foreign brands because China hadn't got its act together yet in terms of manufacturing high quality goods. But the reality is that domestic brands now are incredible. We see a lot of people in Australia and a lot of Western markets carry on Xiaomi phones. I can tell you that 10 out of 10 people that I've spoken to in Australia who love drones and ask them which brand do you buy and they go, oh, DJI all the way. None of them know it's Chinese, not a single one. Okay, but the quality is incredible. Liaoning is the bottom left here, the sports shoe company. That's also penetrating in Western markets, and that's quite incredible. Okay, one of the other ways in terms of what services are doing at the moment, in terms of the offering, and I'll just talk about this, is the fact of something's happened here. Sorry. Is this group called Douyin. I think everyone on the call today has heard about Douyin. If you haven't, then that is the Chinese word for TikTok. Okay, so TikTok, as it stands today, has 600 million active users on the platform, and on average, they're spending 2 hours a day. 2 hours a day consuming media on TikTok. And for those of you that are not familiar with TikTok, I personally don't use it myself, but it's all around short videos. And these short videos then allow people to go and share them. You have social media influencers, they want to sell something, or they're being paid to promote a particular good or a cosmetic item or something like that. So a couple of months ago, so TikTok has been incredibly successful. A couple of months ago, another social media platform called WeChat, which has 1.2 billion active daily users, a platform I use myself, decided to create a competitor product to TikTok, which is pretty simple, allowing people to upload short videos on that platform. There are now 300 million daily active users out of that 1.2 billion that use the WeChat equivalent of TikTok. And that has added in of itself to our valuation point about another $300 billion to the market cap. And that's in 3 months. That's in 3 months. We're talking very big numbers here, but that is the potential that we see going forward. And it's just they're building from strength to strength. Now, the stock story I want to share with everyone today is an SOE. Now, we have no concerns about buying an SOE. This is an A-share company. So if you see the stock code with a CH at the end, that's an A stock. Now, these guys are the equivalent of like a DFS. And what they do is that they sell duty-free products, 240 stores across 30 cities across Greater China and Cambodia. Historically speaking, one of the biggest strengths of the Chinese consumer is that out of the entire addressable global duty-free market, which is about $82 billion, 40% of that total spending in 2019 were by Chinese nationals. But only 20% of that 40% was duty-free spending that was happening in onshore China. Okay. For those of you that are familiar with Hainan is a luxury place. It's like the Bahamas, very poor island part of China, but very luxurious resorts. But there's a big duty-free presence there. And China Tourism Group Duty Free Corp has a very meaningful presence there. And we've been monitoring the company for years. It's a great company, but didn't really hit a valuation we were comfortable with. So the opportunity came up in September 2020, and there was potentially some new competition that was going to occur in Hainan with new change in government policy. But after we did our own channel checks, as well as talked to a number of industry experts, we found that CTG's actual proposition is much stronger. Think of it like Chemist Warehouse. Why can Chemist Warehouse offer everyone so much cheaper on prescription medicines and other goods like vitamins and whatever else Chemist Warehouse sells nowadays? The reason is volume. So one of the things that CTG do is that they will sell you an LV bag, or they'll sell you a range of other duty-free goods at like a 10% discount compared to everybody else. And that drives volume because they can negotiate with the manufacturer and get a much better volume base out of it. So we saw the opportunity in September 2020. We started getting in around sort of late October, early November. So yes, unfortunately, we didn't get at the lowest point. But you know, we have pretty much doubled our money as at today in a short matter of months. This is not a short-term trade for us. This is in our top 10 holdings and a very, very good company indeed. So this is our Asia fund metrics. As you see here, last year we did 30%. Oh, sorry. 12 months to end of January, we've done 30% net of fees against our peers. We outperformed by about 10%, 1,000 basis points, and we still have very solidly kept our Sharpe ratios, our information ratios, which is reflective of how much risk we take in order to generate the returns for investors, is also far superior, especially on the information ratio side. We're under a 5 and a 7-year basis. Our competitors are going through a negative information ratio, hence taking excess levels of risk to generate the performance for your underlying investors. In terms of our sector breakdown as it stands here, we have a very marketed tilt towards Greater China. So that's the mixture of Hong Kong, A shares, Taiwan, H shares, red chips, are all part of that group. And you can see A shares compared to even 12 months ago, we probably have less than 5% of the portfolio tilted towards A shares. We now have 17%. This is a massive story in which fund managers, unless you have licensing to do so, cannot enter into this market where everyone is trying to crowd themselves into it to get set for the next 10 years. So we also have the big tilt towards IT and consumer discretionary, as you can see here, very, very important, and those are structural themes. We have no doubt that we will trim stocks. So we got out of Alibaba late last year, almost all of it. It was sort of 10% of the portfolio. It's now under 1 because we felt the antitrust issues coming down the government pipeline were a risk. It's no reflection on Alibaba as a bad company. We have no doubt we'll re-enter into Alibaba at some point, but it's not in our line of sight at the moment. Instead, we've decided to go into Pinduoduo, which is sort of the third largest operator. Most people have no idea who this company is either. It is listed in the United States. It is a direct competitor to the likes of Alibaba as well as JD.com. I'll probably use that as a case study in next month's webinar. But you can see here CTG that I talked about. That's a large high conviction stock for us at 4.6% of the portfolio. And the top Tencent, which is I talked about, the $1.2 billion platform, fantastic, going from strength to strength. Just added TikTok to its TikTok type service to their belt. And then Samsung Electronics and Taiwan Semiconductor Manufacturing Company, those are what we're holding here because of the fact that the world is short semiconductors. Okay, so one of the largest inflation inputs into the world at the moment is via the lack of semiconductors. I have a personal friend of mine who wanted to buy a Mercedes A-Class, I think, in Australia. They said, we'll build to order for you, but you need to sign a waiver because some of the safety technology will not be inbuilt in the car that you order. Why? Because we can't get semiconductors. Okay, so this is the sort of the problem that we have here. With all this sort of tech-heavy consumer stocks, our P for the portfolio is 16 times. Very, very good. Very, very healthy, and the dividend yield of the portfolio is also reasonably strong at about 200 odd basis points. You can see where we made our money for the last 12 months as well. Some fantastic attribution there as well for investors. For our China flagship fund, we did 30 odd % last year net of fees, so the high conviction China play for those of you that are interested here. We have slightly higher exposure to A shares at 18%, but very, very similar. But a very, very good strategy overall as well. And in the top 10 holdings here, also quite similar. Obviously, there is no Samsung. We have some of the pharmaceutical biologics companies starting to flow through. We've got China Merchants Bank in the portfolio as a deep value play, also reflective of the fact that higher stockbroking levels as well. And the P of this portfolio is 20.5 times, which is also lower than the benchmark. Very happy to hold these names. And our largest attribution that got to the contribution of the total fund performance last year was Tencent Holdings here. So you can see 15% of our portfolio is in Tencent. In terms of platform availability, a couple of you have asked us to put that up in our webinar, so it's nice and clear. The most recent addition is the Premium Asia Fund is now available on IDLF, which is great. So please feel free to openly use that avenue if that is your platform of choice. For those of you that are in New Zealand, you know that our funds are available on both FNZ and Aegis platforms. So those are the major ones for you guys. This is more for the Aussie guys here. And last but not least, just to remind everyone, at 2:30 this afternoon, we will have our webinar on fixed income in a world where over 50% of the debt that you buy is paying less than 100 basis points, and more than 80% of the debt that you can buy in the world, corporate and government, is paying you less than 2%. There is always options out there if you're willing to explore. So please join us at our 2:30 webinar. So I am 3 minutes over. For those of you that want to contact me directly, I'm the state manager for Victoria, Tasmania and South Australia. Derek, my other associate, looks after all the other states and also look after New Zealand as well as Clayton. Feel free to reach out to us if you have any questions. And I hope everyone has a great afternoon, as there are no questions that have come up. Thank you very much.